Imagine making $2,000, $3,000, $5,000 on your prop account, submitting a payout request and having that payout request denied for a rule you didn't even know about. That would be so terrible, right? So what's up, everyone? It's Flexing Joe, and I'm back to talk to you today about a very, very important rule that Apex Trader Funding has. And to my knowledge, they're the only prop firm that has this rule. So I'm going to break that rule down for you. I'm going to show you some live examples. I'm going to show you how you can avoid violating that rule and how to trade properly with tight risk management to make sure that if you earn a payout, you have a better chance of getting that payout approved. So let's get into it. First things first, let's get into this MAE rule. What does it mean? Most traders have probably never heard of it because it is a trading statistic that is not very often tracked. It's certainly not talked about on social media. And frankly, people really only care about the wins and the losses. They don't care about this. So what this means is the maximum adverse excursion. That's what MAE stands for. It is how far a trade pulls against you and goes red on you before you close it out or before it turns back into a profitable trade. So in the case of the Apex accounts, their rule states that you cannot have a trade go against you in drawdown more than 30% of that day's starting profits. That can be a little bit confusing for some people because on day one, when you've just gotten the account, you have no profit, right? In reality, what they're saying is it can't go against you more than 30% of your total drawdown. So let's think about a 50K account. The Apex 50K accounts, they're really $2,500 accounts. That's what I got right here is $2,500. Now they call it a 50K, but in reality, we all know you only have $2,500 to play with. If you lose that $2,500, your account is gone. So let's think about this very simply. What is 30% of $2,500? It's $750. So what I'm going to do here is I'll count out 700s. 1, 2, 3, 4, 5, 6, 7. So I got $700 right here. And then I didn't have any 10s or 50s, so I only got some 20s here. So I got three 20s. What we'll do is we'll just go ahead and rip one in half. And now I have $750, okay? So on one hand, I got what's 2,500 minus 750 really quick, Joe, don't be an idiot. 1,750. And then on the other hand, I got 750. All right. 750, 1,750. So looking at this, if you were really holding this money in your hand, right? And you were wondering, where's the tape so I can fix this $20 bill? No, for real. Would you truly, if it was your $2,500 account, would you truly let one singular trade dip more than $750 against you? Because that's the limit. That's the threshold. Do not let the trade go more than 30% of your account. Now, you got to factor in for things like slippage. You got to factor things for like commissions, and I would say you don't even want to let it dip like more than 25%. Just a quick fun fact. I actually had a full head of hair before this rule came out. Would you really risk 750 of your dollars if you only had 2,500 in total? You're really going to risk 750? Probably not, because if you only had $2,500 to fund an account, you'd be thinking that money's sacred to me. So what they're trying to do is say, hey, we want people to trade smaller, trade smarter, etc. Okay. So now let's just say, for the sake of argument, right, that you don't have a $2,500 account anymore because, your first day you lost a couple $100 or whatever. And so let's just say, you're down to $2,000, right? We'll count it out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so I got $2,000 here. This is my $2,000 account. 30% of 2,000, pretty simple, right? 1, 2, 3, 4, 5, 6. $600. Again, same question. You've lost money on day one, or have you lost money across a few days, and now you're down to a $2,000 account? Are you really going to risk? Are you really going to risk this $600 out of your $2,000 account on one singular trade? You probably wouldn't, right? It wouldn't be very responsible of you. So again, you need to look at where the stop is on the account and where your current profit is or your current account balance. Figure out that difference. How much drawdown do I have left? Okay, times that by 0.3. That's your maximum adverse excursion. Now, the best way to avoid this would be to be smarter, right? And that's either risking less or, on the MAE rule, risking less in terms of like risking only 25%, right? Or even being like much more intelligent with your trading and instilling a hard stop on your account. Like in Rhythmic, you can set your account so that it'll stop you out. Regardless, right? The objective here is trade smaller, trade smarter, and not have the market go against you in such a significant way that's going to deny your payouts. Because especially when you're early on in the account, that's not what you want to have happen. You want to be building this account up slowly so you can get to the point where you take payouts. So let me give you an example here on the charts. All right, so let's say you're an NQ trader. Remember when you first start your accounts on Apex, again, we're going with the 50Ks, you're limited to half of your contracts. You can't trade more than 5 contracts on NQ or 50 micros if you're trading MNQ. So I don't know what your strategy is, but let's just say for the sake of argument here, you think, that it's a good idea to go long right here. And you're looking to go long on NQ and you want to trade maximum sizing.
Order submitted. Order stop filled.
Well, that sucked, didn't it? And honestly, that was unplanned, and that was minus $1,500. So like, that's pretty hysterical because I wasn't planning that. But whole point being there is before you even had time to react, you threw on max size, and like that was it. You're over. And not only that, you violated the MAE rule. Like you're cooked, dude. You are cooked. So let's go ahead. We'll just reset this and try again. You think it's a good idea to go long. You're trading NQ and you decide, hey, you know what? I'm going to be smart. I'm only going to trade one contract. Okay. So you're going to trade one contract and you want to go long.
Order filled.
So now I have the advantage of using replay, right? I'm going to hit pause. So what you can do is you can see where does $750 more or less stop you out? There's $740. Maybe you're targeting this high. So it's like, it's better than a 1-to-1, whatever your strategy is. That doesn't matter, right? What matters here is the risk. What matters is MAE, right? Maximum adverse excursion. Now, in the event of what happened earlier, if you get a knife down and you get slipped, it's easy to go over this 740 set, that you have set here. Maybe you're trying to account for a little bit of commissions and go to 780, 790, whatever, because it's NQ, it's volatile, right? She's a crazy woman. She go wherever she wants to go. And you were just along for the ride, buddy. So why would you do that, right? Like, why would you put yourself in that position? You want to limit that. You want to put yourself, all right, hey, maybe I'll only risk 600. That gives me, if I'm risking 600, that gives me another 7.5 points of slippage and commissions. That's a little bit better. But if things are extremely volatile, I still might violate the rule accidentally, right? So what's your best bet? Your best bet is to size down at first. Your best bet is to play it small, and trade micros. Even if you still trade 10 micros or 8 micros, it allows you to scale out a little bit into profit, locking some of those gains in, and then limit your risk exposure to the downside. Let's look at it in terms of MNQ. We're here at the same point in the market, deciding to trade micros because that affords us a lot more leeway in the trade. We don't have to be as precise with our entry, and it gives us a lot more drawdown to work with. So if you were to take 5 micros here, and use the same exact trade idea, targeting up there, maybe risking this candle's low, you see even just risking this candle's low gives you less than that $750 MAE. You have a lot more room for this trade to move around and breathe while you give it an opportunity to work, versus if you were trading double that, and we'll just add 5 more micros in right here.
Filled.
Now we have 10 micros, the equivalent of 1 mini, and you see where that just wicked down. It pretty much just wicked down right to your MAE rule violation at $757, right? I'm zooming way in. You can see, technically speaking, you're a hair over it if you had 1 mini on. So the micros offer you greater flexibility, a lot more leeway to be right without having to be picture perfect precise, because trading the market isn't like that. One big question that traders have is, after taking a stop, how much do they have available to be able to utilize the MAE and understand where it is? The easiest answer is it goes off of the start of the day. It always goes off of the start of the day. So if you lose $500 on your first trade and your MAE limit was $750, you can lose another $500 on the next trade. You can still risk another $500 because the MAE rule is your starting account balance versus the trailing drawdown limit for that day, what the difference is there. So if you have $2,500 on day one, you could, in theory, take 4 losing trades of minus $500, be down $2,000 on the day, and have not violated the MAE rule because it's on a per trade basis based off of the starting drawdown available or starting profits available for that particular day. That would be a very bad day, but you would still be in or within the limitations of this rule. All right, now, like any great trader, I'm going to double my money here. So get some tape out here for this. I really kind of jacked this up here. It's like I ripped it and like ripped it in layers. Why did I do this? Babe, can you get me the packing tape? I don't think Scotch tape's going to cut it. Oh. Blooper reel. There we go, Mr. Jackson. Good as new. Thanks for your help.